Hi, I'm broadcasting. Hello, good morning and welcome. It is 10 o'clock and welcome to this seminar about staff equity rewards. This is for the Institute of Financial Accountants. My name is Paul Davison and I am the Director of Business Taxes at PD Tax Consultants. We're based in Leeds, West Yorkshire. I've been a tax professional now for a lot of years, and I've been qualified with the ACCA for 24 years, and with the CIOT for 17 years. Today, I'm assisted by my colleague Aimee, who will be helping out at the end with questions. And as ever, please note that these slides do not constitute advice. So here's the running order and some guidance about today's session. You can all relax because your mics won't be enabled at any point, so you don't have to say anything. But there will be some interaction, because if you have any questions, please send them in as soon as they come into your head via the Q&A button to Aimee. Aimee will sort those questions and ask them at the end. As soon as you get your question in, there could be quite a lot of questions. I haven't got time for that many questions, so please get them in as soon as possible. Aimee says that the sound is a bit intermittent, so I'm just going to try to use my other web. Right. I changed my Wi-Fi. Hopefully that's a little bit better, but apparently the sound's been a little bit intermittent. I'll press on at the moment and see where we get to. There are a couple of polls in the middle, so get ready for them. And if your question isn't answered, we'll contact you at the end for follow-up discussion. The webinar, we're going to go through the main principles of shares. I'm going to be as succinct as possible. You might not understand all the points to your liking, and you might not agree with all the points. There's going to be something to consider, and you can follow up on the areas you feel appropriate. So, on to the detail. Today's session, we're going to be talking about equity for staff, as mentioned. This is the lineup, the purpose, why do we provide shares to employees, how do the staff get the shares, valuation of the staff member of the company. How do we go about valuing the shares? Because that's important. What to consider from a legal point of view, and also share option schemes. So the purpose of providing shares to staff is that it's an incentivization for them. Good staff in key roles are hard to find and even harder to hold on to. There is some comments here really about what you might hear from employers about the provision of equity to staff. There's only so much equity to go around, we can't give it away easily. We want to incentivize key employees, but we don't want to have to offer shares to all employees, just the key employees. Shares don't always mean a big cost now. They provide an incentivization in a different way. They provide belonging, recognition, and ownership. So in short, the provision of shares is a way of incentivizing staff as opposed to cash. And here's some of the things that it might incentivize them by. It rewards them for past performance, so it's a recognition for what they've done in the past. It's a way of retaining them because once they've got shares, they're working towards the goals for the company. It's a way of motivating them to create growth because if the business develops, then their shareholding in that company will grow. It's a way of targeting specific objectives because we can target ways that they can build. It provides potential promotion for wider share ownership within the company. Succession planning. So once there's a couple of shareholders in the company and they're getting towards retirement, providing shares to key members of staff is a way of building towards succession, them doing an MBO at some point. And it's a way really of aligning key employees' interests with the shareholders because shareholders obviously want to make profits. Employees don't always see that as a big deal. So if the key employees also have shares in the company, they can understand the importance of making profits and building the company, striving together towards the goal. How do staff get shares in a company? Well, there's a few different ways there you can see. We can gift them shares outright now, with no strings attached. We can sell them shares discounted or full market value now. We can set out a roadmap, a non-binding roadmap, on which they can expect to get shares and how they would get those shares. I think some care needs to be done if it's going to be non-binding to make sure you get the legals right on that, and maybe talk to the solicitor to make sure that that is not binding. It's just a plan which we're all working towards. Or we can give them options over shares. Now, option over a share is something which they could definitively exercise in the future if performance criteria are met. So there's 4 different ways there of providing equity to staff, and really it's whichever one feels best to the existing shareholders or management or the board at the time, really. So what type of shares could we provide to the employees? Well, clearly we could provide full unrestricted shares. We could provide restricted shares. So that could be shares with potentially only rights to income or only rights to capital, say, depending on what type of, how you want to incentivize them. Strictly speaking, I think restricted shares with rights to income only try to avoid really because it's open to challenge from HMRC if you're trying to provide normal, especially normal salary to employees through restricted shares, that can often come a cropper if HMRC look into it. Or we could provide full shares in the company, but in a different class to the main owners. Again, some care needs to be taken there, because I think obviously a different class, you could pay different dividends compared on the main shares compared to the key staff shares. But that needs some care, because if the key staff thinks that actually, well, these shares are all well and good, but presumably they might not pay dividends on my shares if they don't want to. They just pay shares on their own shares and not pay shares on mine. So that could be actually disincentivization to some extent. So if you're going to provide shares in different classes, I think some care needs to be taken there. Okay. So we've got a poll now, just to get you involved a little bit. So the questions are: have you ever considered giving equity to key staff members? So this could be for you, or it could be for your clients, I suppose. No, we don't want to give away equity. No, because we'd never had appropriate key staff. Yes, but it was too complicated. Yes, it's been done and it was a success. And yes, it's been done, but it was unsuccessful. Obviously, this could be for your own firm, or it could be for, as I say, your clients. Maybe think about situations where you've done that. I'm just going to launch the poll now. I've got 30 seconds to vote. Okay, thank you very much for your pollings. I'm just going to share the results. Oh, that's the wrong poll, actually. Sorry, I think I launched the wrong poll. Hold on. Sorry, I launched the wrong poll there. So I definitely launched the polling. This is the right poll. Have you considered giving equity to staff members? No, I don't want to give away equity. No, never had appropriate key staff. Yes, it was too complicated. Yes, we've done it. It's been a success. Yes, we've done it, and it was unsuccessful. Sorry about that. Okay, thank you very much for that. Share the results. And the winner there was never had appropriate key staff. That's interesting. Obviously, staff are important, and it's worth. But that's interesting. Okay, thank you very much. Okay, on to the next slide. So I'm now to talk about the taxation of providing shares. So obviously we talked there about why you would provide shares to an employee, or why your clients might provide shares to an employee for incentivizations, but taxation is obviously a complicated area with the provision of shares to employees. And that's why you're here today, to hear about taxation. Because the taxation rules actually have the potential to lace the provision of equity with a disincentive. Because what can happen is that you can provide shares to an employee, but actually the employee has to pay tax on those shares, but it doesn't have any cash to pay that tax. So that can actually be quite a significant disincentive. So that's why firms like ourselves tend to advise on arrangements involving employee equity, because what we're trying to do really is to mitigate any negative tax effects if we can, to provide that full incentive rather than saying, "Oh, sorry, here's the shares, but also here's a big tax bill." So that's why firms like us really get involved in the provision of employee equity. So what is the tax treatment? Well, an employee is subject to income tax, probably not national insurance, on the market value of the share at the date of acquisition, less the price paid by the employee for that security. So whatever value they get for nothing, i.e. they don't pay for, is subject to income tax at their marginal rate, as I mentioned there. And that does, as I mentioned there, require an entry on their tax return form for this. So the tax probably is going to be at 40% if they're a key, but maybe they're earning 40, 50, 60,000 pounds of salary. So he's going to be paying at least 40% tax. He could be paying higher. It's also worth bearing in mind, though, that as you see there, that the company, the employee company, will benefit from a corporation tax deduction for the amount calculated in A. So this is something that's often missed, in that the employee pays income tax on that benefit, but the company does get an equal and opposite tax deduction against its corporation tax for that amount, properly relieved at 19%. So that's something to bear in mind, because there's nothing to actually provide that mechanism in the CT return. There's no payment as such. So something to bear in mind when you're doing the tax return form, CT return for a company that's provided equity to staff, make sure to flag that in your brain, because you need to make an adjustment to the CT comp for that. So what is the market value of the shares? It's a very important question, because obviously, as we found out from the previous slide, the tax charge is based on the market value of shares at the date the share was provided. Obviously, if the employee pays full market rate for the share, there's no tax bill. But if you pay £1 for the share, there's going to be a tax bill, and that's going to be calculated on this basis. And what we want to try to do really is we want to try to work with a valuation that gives us a low valuation. If there's a range of valuations, we want that to be in the low part of that valuation, because also obviously mitigates the tax bill for the employee. It's important to note that we can only agree the valuation with HMRC if we have an EMI share option scheme. If we're just providing shares directly to the employee, we can't agree the valuation with the HMRC prior to the transaction. We have to do the report and then wait to see if HMRC inquire. So here's a slide here about share valuations and how they're calculated. Quite a brief slide. So if we have an ongoing profitable trading business, then the business tends to be valued on the basis of a PE basis, price earnings basis, or an EBITDA basis. So some sort of price earnings basis based on profitability. That tends to be the way to value a profitable company. If we have a company making a loss, then it tends to be based on a net assets basis, because obviously there's no goodwill. So we have to look at what the company's worth, its balance sheet. Obviously what we want really is the company to be growing, because the growth gives us the incentivization for the staff member, but we can provide shares in companies that are making losses, and generally those shares might only be worth, as I say, might only be worth the balance sheet. Now, the third point there is very important, because as we only tend to be giving away small percentages of shares, then the case law generally stipulates that we only have to look at the last set of submitted accounts to decide what the profitability of the company is. We don't have to look at management accounts. What we're looking at it really is figures which are sort of 8 months old, 6 months old. And that can be really handy, especially if we're sort of in the first years of trading, because the company might not have submitted any accounts yet. We might know it's making some profits, but if it's not submitted any accounts, then the shares are still worth nominal value. And that is quite an interesting point and worth thinking about. Another very important point with valuation is the discount for minorities. This is an important concept and will help to reduce the value of the shares. As I say, if we have a 5% shareholding in a company which only has one other shareholder, so the other shareholder has 95% of the shares, then clearly that 95%, so that 5% shareholding is going to have very little influence, and the discount on the shares is certainly going to be over 50%. It might be as high as 60 or 70%, which is going to reduce the value to sort of 30% of the actual full value. So that's a very important concept. And what we do is we pull together the report based on the profit, look at the earnings, look at the assumptions, adjust for things like, as people being paid by dividends rather than remuneration, that can also reduce the value. Other items not on a market value, adjust for those. We prepare the report, and that's the basis of the provision of the shares. And PD Tax do prepare a number of share valuations for our accountant clients and other clients. Just a little refresher there really on the tax compliance requirements for the provision of shares. The company, if a employee provided with shares in a particular tax year, then the employer must return an employer-related security return. I think it's due for the 6th of July every year after the year end. There's no reminders from HMRC about this. You just got to ask the question to the company: have you provided any equity to staff during the year? And we all know now that this used to be Form 42, but now it's online, and it's provided through the company's government gateway system online. There are some logistical difficulties with this, because you actually have to set up the part of the government gateway which is relevant for employer-related security return before you can actually make the return. And setting it up might take 2 or 3 weeks to actually come online once you've pressed that button. So you need to do it early in the process to avoid any penalties. And we do know that HMRC do penalise people for late employer-related security returns. So as mentioned before, remember though, if there is a charge to income tax, there's also the equal and opposite tax rate for the company. Again, there's no reminder for you on that one. You just got to get that on your return. And finally, another reminder, there's no P11D for the provision of shares. It only goes on the employee's tax return form. No P11D for shares. Now, the legal aspects of the provision of shares is very important, and it can't be stressed how important it is. It's important that the provision of equity is properly documented. We don't want any complications when it comes to saying who's got the shares. Has it been reported on properly on the confirmation statement? We don't want any wrangles about who's got the shares, who's not got the shares. When it comes to due diligence, if the company's being sold to somebody else, we want the employee, we want the company's house stuff to be pucker, totally up to date, because it can cause problems. So if any doubts with this, we really advise that you do use a solicitor, because your accountants, not solicitors. I would advise you to use solicitors generally to avoid any wranglings. And a shareholders agreement. This is going to be extremely important. If anybody is going to say to somebody, yeah, give somebody 5% of the shares, what we don't want to happen is for them to leave employment, go away with 5% of the company, and then keep that 5% of the company, because that causes problems. We want really the key provision within a shareholders agreement is that they have to sell them back for the price they paid for them if they ever leave employment. That is a really key provision. There's also obviously a lot of other provisions that go into a shareholders agreement, but that definitely needs to be signed before bringing anybody in as a minority. Okay, so that's the sort of section really on normal shares and how the normal principles around shares. Now we move on to the concept of share options, which is a little bit hard to understand. But one thing it's not, a share option is not a share. It's a piece of paper saying that if certain criteria are met, that the employee will get the share somewhere down the line. So what is the purpose of a share option scheme? Well, it can incentivize staff without actually having to give them anything in short. It's jam tomorrow. So what that means is actually we can say that, one of the criteria for a share option scheme could be that in 5 years' time, a basic criteria for a share option scheme could be in 5 years' time, if you're still an employee, you will get 5% of the company, full stop. That's a very basic share option scheme. And what that means is obviously that in those 5 years, that individual doesn't get any dividends, no proceeds of the company sold, potentially, nothing for 5 years. All they get is a piece of paper saying they're going to get shares in 5 years' time. So that's why I say jam tomorrow, because obviously it's quite a cheap way of saying you will get shares, but you have to wait. It doesn't cost anything in that 5-year period, apart from the implementation of the share option scheme. But the communication here of the incentive is vital, because there's no real point in setting up a share option scheme unless the employee understands the reason why they're getting it and how they will get their shares, i.e. what are the criteria for them getting the shares. If they don't understand that, there's no point in setting up a share option scheme, because it's all about incentivizing them to bring them into the fold, to get them working in the same way as the main shareholders. So you might have heard of the term EMI, and an EMI scheme is effectively a share option scheme. What is an EMI scheme? Well, EMI stands for the Enterprise Management Incentive Scheme, which is an HMRC term. So because it's an HMRC tax-badged advantage scheme. The EMI badge started in 2000 and is really the main share option scheme that people are going to be using for SME businesses, small company businesses. It's really the main share option scheme that you're going to be looking at with your clients. So why is it popular when other tax advantage schemes exist? Well, the EMI scheme, as I say, is good because it's a share option scheme, and share option schemes have the advantage of giving people shares, but later. Letting people, if you're bringing in a key member of staff, but you want to give them shares, don't give them shares now, you give them shares later. So that's why it's good, because you're not providing shares straight away. They're having to wait for their incentive. So the concept of a share option scheme is a good concept for business owners. So why is the EMI popular? Because the EMI scheme provides the tax protection that people want for small companies. It's the only real EMI scheme that gives protection for small companies and allows you to decide on whether you want to give shares to one person, two people, or all the people. With other tax advantage schemes, you tend to have to give shares to all the staff to get the tax benefits. And often, people don't want that, because that is going to really dilute the share capital. Quite often they only want to advise 1, 2, 3 people, those key staff. That's why the EMI scheme badge is popular. It's very flexible. So what are the tax advantages? So I've got a little calculation there. And effectively the tax advantage is that any growth in the underlying share between the grant and the exercise of an option isn't subject to income tax. So from the first part of the slides, we know that if you provide a share, that you have to pay tax on the market value of the share at that date, less the price paid. Now, the grant of an option, the grant of an option isn't a taxable event. That's the first key point there, which isn't actually on that slide. But if you grant any option, it's not a taxable event. So if we have an option here, which is in 5 years' time, and we pay, shares are currently worth £1, but in 5 years' time, the shares are worth £1,000. Without EMI qualification, the employee will be subject to income tax on £999 at the exercise of the option. So if it was a normal bog standard employee unapproved share scheme, it's just the same as providing the shares. You're giving them some shares worth £1,000, and they've only paid £1, so they've got to pay income tax on £999. If we can arrange for the scheme to be under the EMI arrangement, then actually in that situation there is no income tax on the exercise of the option, because what the EMI scheme does, it provides, as I said in the first point there, it provides relief from income tax on the growth of the share from the date of grant to the date of exercise. So with an EMI scheme, what would happen here is that we would exercise the option in year 5. There would be no income tax payable on that receipt of the share. It's now worth £1,000. And the point to bear in mind there is that going forwards, the individual has only paid £1 for that share. So if in 10 years' time, those shares are then sold for £2,000, there's a capital gain of £1,999. So you can see there that the EMI scheme is very desirable because it stops the employee from paying income tax on the exercise of the option, which is a fairly important part of the planning. Yeah, we had this poll earlier. we might as well just release it again. Do business owners understand the purpose and mechanism of share options? Yes, they understand both the purpose and mechanism. Yes, they understand the purpose, but don't follow the mechanism. Yes, the Aimee badge actually confuses them, sort of, but could something be done to make it an actual scheme that is easy to implement? No, they are too complicated, and even I struggle. Now, I could try and relaunch the poll. It's going to stop saying this. Oh, here's the. Oh no, that's wrong. Sorry. Poll 2. Share results. No. I'll tell you what, I will relaunch the poll for poll 2 and see what the answers are for a second time. Continue. So yeah, just relaunching the poll there for poll 2. Do business owners understand the purpose and mechanisms of share options? Yes, they understand both the purpose and mechanism. Yes, they understand the purpose, but don't follow the mechanism. Yes, but the EMI badge confuses them, sort of, but could something be done to make it an actual scheme that's easy to implement? No, they are too complicated, and even I struggle. Thank you for your poll there. Right, so that's the results. The by far the winner is sort of, but could something be done to actually make it an actual scheme that's easy to implement? Some people said that they do understand the purpose and the mechanism, but obviously by far the biggest one is, can we make it simpler? And I think that's a fair point. I think what HMRC have tried to do really is try to take the concept of a share option scheme and put something on top of it, whereas actually, if they could find a way of having a clearer way of doing it, I'm sure more people would understand it and do it. As it is actually quite a good mechanism for incentivizing staff. And if you don't understand it, then obviously utilizing a firm like PD Tax is a good way of talking to your clients about it and getting your clients to understand it in a bit more detail. But yeah, it is a complicated topic, and that's why we're talking about it today, to try to demystify it to some extent. Okay. Thank you for your votes there and your. Right. So now we're on to a bit more detail about your share option schemes. To make things, try to explain to you the two ways in which practically a share option scheme could work. So the first option, version 1 of an EMI share option scheme is that the employees get a tax efficient share of the proceeds on a future sale of the company. Version 2 is that the employees get a share of the equity going forwards on an ongoing basis, and the directors and shareholders get to cash out for shares sold to them. So let's just look at the version 1 first. The version 1 is a relatively straightforward concept, and you can use the EMI scheme to do this. So the options are granted now over shares in a trading company. The options are only exercisable the company being sold to a third party. So what happens is if the company is sold to a third party, then immediately prior to that sale, those options are exercised, and the individual who had those options gets to have 5%, 10% of the proceeds immediately, because what they're getting is getting the shares, and then immediately they've been sold. So in the example before, where we had shares being worth £1 and them being sold for £2,000 in 10 years' time, then in that situation, the individual will have to pay £1. If the company's then sold in 10 years' time, the individual will pay £1 to get those shares, and then immediately the shares will be subject to the buyout by the buyer, and they will get £2,000 for those shares, and that £2,000 will be subject to capital gains. So in that situation, they'd be covered by the annual capital gains exemption. Normally, if the figures are bigger, which they tend to be, then you would tend to get, if the option's been in place for more than 2 years, then the employee will pay 10% on those proceeds, rather than 45%, say, if it was sort of a bonus on the company being sold. So put 42% there. So this is a really a good way of saying, right, well, actually, we're not going to give you any shares in the company on an ongoing basis. You know, we're not going to give you anything at all until it's sold. But when it is sold, you'll get a nice piece of the pie on sale. So the benefit for the existing shareholders is that the key staff member doesn't get any votes in the meantime. They don't get any rights to dividends. They don't get a chance to sort of, you know, interfere. They only get cash on the sale. And that's good for the employee, because the employee thinks, well, actually, it's worth staying on here for a while, because if we do sell for £1 million, I'm going to get £100,000 because I've got 10%. So, and I'm only paying 10% tax rather than 42%. So that makes a big difference as well. So you can see that's the first version really of an EMI share option scheme. It's to say to the key member of staff, right, you're doing great, we want you to stay, and you're going to get a slice of the pie if we ever sell. That's a relatively straightforward way of doing it. Version 2 is a bit more difficult to understand. It applies to key employees that the owners want to bring in as equity holders on an ongoing basis. So say we had somebody who really is good for the business, there's no buyer in the wings, but this person perhaps is a candidate to buy it out, do an MBO in the future, perhaps give them 20% of the shares through an EMI scheme in 3 years' time, 5 years' time. And then that gives them sort of a step on to buy the company out in 7, 8 years' time. Gives them a step towards an MBO. But what are the objectives of this version 2? Because we don't want the shareholders to be diluted, but we do want the ongoing shareholder to be fully incentivized going forward. We've got a case study here as to how this version might work, which is something we did. It's just an actual client case we worked on recently. So in 2014, one of our clients, a plumbing company, which had just started business really, owned by husband and wife, offered EMI share option schemes to 2 members of staff. They offered options over 22.5% of the share capital. He did say to us, shall I give these 2 guys here really are key to the business? Shall I give them 22.5% of the capital now or later? And I said, well, if you do this share option scheme, it's got potentially good benefits for everybody. So we did it via a share option scheme that said if in 5 years' time certain company certain company performance goals are met, you'll get your 22.5% of the company each. And those company performance goals are around the profitability of the company, sort of stepping up over years 2, 3, and 4. In 2019, 5 years later, both individuals were employees of the company still, and the financial goals had been met. So the share option scheme, share options were exercisable, and the share scheme had met its objectives. So what was the tax analysis? We valued the 45% shareholding to be provided to the two guys at 2.5 million quid. So what happened was the main shareholder got 2.5 million pounds out of the company because the company effectively funded the buying of the shares, and they paid 10% to entrepreneurs relief because the limits weren't £1 million at the time. The company got a CT deduction of £2.5 million, which was saved at tax at 19%, and the employees got their shares for £45, and there were no adverse tax consequences for them. So what we're doing here really is, via this EMI version 2 scheme, we're saying, right, we're going to provide the shares to you, and these shares are going to be provided by the existing shareholders, and there's arrangements to be put in place that say, actually, through an EBT, I don't want to give you my shares for nothing. I'm going to give you my shares for cash, and because we're incentivizing the employee, that money is provided out of the company, and it goes straight to the main shareholder, who pays 10% on it. So that scheme really only works if the employees and owners are committed to drive the business forward, because that increases the value of shares and gives you those tax benefits that I've just discussed there. Obviously, that's quite a complicated arrangement, and I've run through that quite quickly. If you do want me to talk to you about it, happy to take an email from you or call me so you can understand it in more detail. So with share options in general, if the share option scheme has not been exercised yet and the employee leaves employment, those options will lapse automatically. As soon as they leave employment and they've not got shares, the scheme lapses for them. But again, the shareholders agreement is very important. Once they get those shares, one of the conditions of exercising the options is that they must sign a shareholders agreement. And again, the same provision applies, that if that employee leaves employment and they've only paid £1 for those shares, then they only get £1 back when they leave employment and give those shares back. So that's really the end of that session on staff incentivisation. I hope you've been able to hear me okay. Having some Wi-Fi problems this morning, and sorry about the polling. The results did come through in the end. Aimee, are there any questions to be asked about today's seminar? We've got about 5 minutes before the end of the session.
Yeah, I've got a few questions. So, are there any risks from HMRC when using shares of different classes?
Yeah, it's a good question. It depends on the situation. I think the main risk is if you are providing effectively salary to employee through shares, because that employee has a right to income only. If it is a share which only has rights to dividends, HMRC might still say that actually that share is the dividend on that share is salary rather than dividends, and therefore they'll come after you for national insurance. All the facts are different. Every case is different, and that's still a threat. I think if an employee is paid a normal market rate basic, and a bonus is paid via that type of arrangement, that's got a better fact pattern. Still not perfect, but got a better fact pattern. Shares paid to stuff for family members tends to be better in terms of different classes of shares. But again, if somebody's receiving a dividend and somebody's not, is there any bounty? Are we into the settlements legislation where we're saying that actually, even though those shares are being paid to somebody else, should that income be the income of the other shareholder because they're sort of giving away their rights to dividends? Yeah, there are risks, and but every case is different. If dividends are paid within if dividends are paid roughly on the basis of the percentage held, that's going to be okay. Generally, I would think.
Okay.
Questions, Aimee?
Will an employee who previously didn't need to file under self-assessment now need to register as a result of the share issue?
That's a good question. I think yes. I think the answer is yes, they would. Because there's no, as I said, if you've ever looked at a P11D, there's no fields on the P11D for the provision of a share. It's the only place you can provide it is on your tax return form. Now, if there's no benefit in kind, if the individual's paid market value for that share, and there's no reason to put it on your tax return form, the company would still need to file an employment-related securities return. But if the employee is paid market rate, then there's no benefit. So there's no requirement to file the tax return form. But then again, there's no de minimis. So if somebody's got a share which is worth £500 and paid £1 for it, that £500 benefit has to go on your tax return form because there's no de minimis. So therefore, it's got to go on your tax return form. So I think the answer to the question, Aimee, is yes. We'd have to register to file a tax return form for that year.
Okay.
One last question.
Final question then. How long does it typically take to get an option scheme set up?
Well, if we're talking in Aimee option scheme, which we probably are, then those steps are understanding the objectives of the scheme with the main shareholder, and talking to them about what sort of percentages they want to provide to the employee and on what criteria, what basis. So that might take a couple of weeks. Then you've got to prepare the share valuation report, another week or so. That has to go off to HMRC for agreement with them. Once they agree it, we can then get all the paperwork in place. So I would think the minimum is going to be 2 months. Normally, I would say about 3 months would be an average time for setting up the scheme. Thank you for the questions, Aimee.
Thank you.
If anybody else who's asked questions with an email following this session. So you can follow us on LinkedIn and Facebook. A recording of this webinar will go up on our YouTube channel, Tax Bites. Our next seminar will be with a firm of financial advisors called TPO on the 11th of December, which you can subscribe to through our normal, through Facebook or through our website, covering family investment companies. And Aimee's going to send out a follow-up email about that. One other thing to bear in mind is that we do, as a firm of tax advisors, we do provide tax advice to many firms of accountants across the country on an independent basis. We don't do accountancy, so we're not looking to do your work for you. And sort of our basic provision for accountants, the starter sort of provision, is the tax sounding board, which effectively is £25 for accountants like yourself. And the £25 fee covers a chat on the phone with you about a specific topic. So you call up, ask to speak to myself or Vicky. Vicky does more the sort of the private client stuff. Call up and ask to speak to us under the tax sounding board. And that's, as I say, that's £25 for 15-minute conversation about whatever you want. It could be just running something past us. It could be getting our thoughts on something. But it's only a conversation, and it's nothing in writing. If you do want proper advice from us, we can obviously discuss that with you and cost things out for you. But the tax sounding board is a good way of sort of testing things out with us. So I hope you've enjoyed the seminar and you've learnt something today, and we hope you have a lovely day. Thank you and goodbye.